Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening with the Russian ruble. If you've been following the channel, you know that the value of the ruble has been falling consistently over the course of the last 12 months. And on the 14th of August, the value fell below the critical $1 to 100 rubles level, which basically meant that 1 ruble was worth 1 US cent. And that was a bridge too far for President Putin. He instructed the Russian central bank to pull their fingers out and do something about it. An emergency meeting was held, and the bank announced an immediate 3.5% increase in the official interest rate in Russia, and the value of the ruble started to appreciate. So that was obviously good news from President Putin's point of view, and meant that everybody could sit down, relax, and have a nice cup of tea. However, unfortunately for Russia, the increase in interest rates has only provided temporary relief, and over the course of the last couple of weeks, we've seen a continued deterioration in the value of the ruble, and the exchange rate against the US dollar is now heading back towards that critical 1 to 100 level. So in today's video, I'll have a look at exactly what's going on with the exchange rate for the ruble against the dollar, the euro, the Chinese yuan, and the Indian rupee, which are the 4 most important currencies from Russia's perspective. We'll take a look at what's going on with interest rates and inflation, and what the potential knock-on implications of Russia's increase in interest rates will actually mean for the Russian economy. We'll then talk about why the value of the Russian ruble is so important, how it impacts on Russia's exports, the cost of all of its imports, what the deterioration in value means for the people in Russia, the implications it has in terms of the attractiveness of the ruble in the international markets, and the potential for dollarization within Russia. And then finally today I'll wrap up with my summary as to what I think is likely to happen with the Russian ruble and the Russian economy over the course of the next 3 to 6 months. This chart shows the exchange rate between the US dollar and the Russian ruble over the course of the last 5 years. And the reason I'm going back over 5 years here is to put into perspective the current value of the ruble against the long-term value. So as you can see, the exchange rate at the time of making this video was 1 US dollar was trading for 96.4 rubles, which means that the current value of the ruble is significantly lower than it's been at any point in the last 5 years, excluding the very brief period when the value of the ruble cratered following Russia's invasion of Ukraine. However, that situation was quickly rectified by the Russian central bank, who stepped into the international markets and started buying rubles to restore the value to around 60 rubles to 1 US dollar, which as you can see was actually the strongest level that it traded at any point in the past 5 years. Now, if we zoom in and have a look at what's been happening over the course of the last 12 months, you can see that the ruble was unable to sustain the level of 60 to 1 US dollar. And over the course of the last year, there has been a consistent and continued decline in the value of the ruble. And as we discussed at the start of the video, it hit its lowest point of more than 100 rubles to 1 US dollar on the 14th of August. So the knee-jerk reaction that was taken by the Russian central bank was to increase interest rates by 3.5%. And the main reason that the Russian central bank did that is that, generally speaking, there is a direct link between the level of interest rates in a country and the value of its currency, with the general logic being higher interest rates attracts in more investment into your country, therefore there's more demand for your currency, and as we know from simple economics, when demand increases for any product, it pushes up the price and therefore improves the value of your currency. But as we also know from all of the other countries that we've investigated on the channel, having high rates of interest doesn't mean that the value of your currency will increase over the long term. If we look at the countries with the highest rates of interest in the world at the moment, Zimbabwe's interest rate is 150%. Argentina has an interest rate of 118%, and in Venezuela it's 56%. And the value of the currency in all those countries is in the toilet. So increasing the official rate of interest won't fix the problems with your currency if there are underlying problems in your economy. And that's exactly what's happening in Russia right now. You can see that over the course of the last couple of weeks, the short-term fix that was introduced by the Bank of Russia has started to wear off, and we're now seeing the value of the ruble continuing to deteriorate. And the main drivers for that are the problems that are going on in the Russian economy. Now, I recently posted a video giving you an update on what's happening in the Russian economy, so if you're interested in finding out exactly what the issues are, check out that video. So the current value of 96.4 rubles to 1 US dollar is exactly where the Russian ruble was on the 10th of August, 4 days before it breached that 100 level. And if you look at the trend, there is a strong likelihood that the ruble could hit that 100 level at some point over the course of the next week or so. And you may be thinking that the exchange rate between the Russian ruble and the US dollar is irrelevant to Russia because there's no longer any significant trade between the two nations. However, unfortunately, from Russia's point of view, a lot of the business that it is doing is being benchmarked in US dollars. And we'll come on to talk about that in more detail later in the video. But in terms of looking at the other currencies that are important to Russia, you can see that the trend is exactly the same for the Chinese yuan. We saw a low point for the value of the ruble on the 14th of August. That position was temporarily addressed by the increase in the interest rates, but over the course of the last 2 weeks, we've started to see a continued deterioration. And the position is exactly the same for the exchange rate between the Russian ruble and the Indian rupee, which is obviously another important relationship from Russia's point of view. Russia has increased the level of trade with India significantly over the course of the last 12 months. And then finally, you can see the same thing is happening between the Russian ruble and the euro. So the big question now is, what is Russia going to do about this? Is it going to increase interest rates again? Now, before we go on any further today, I want to talk to you about today's sponsor, Private Internet Access. Private Internet Access is the world's most transparent VPN provider with over 30 million downloads. Whenever you connect to the internet on a public Wi-Fi network at airports, coffee shops, friends' houses, or even your own home, your data is at risk of being stolen. Hackers can connect to the same Wi-Fi network and have the ability to steal your personal data with ease, including sensitive information such as passwords, keystrokes, and even your photos. Private Internet Access helps protect your personal data by encrypting your internet connection through its world-class server infrastructure, which makes your information shielded and bulletproof. But using Private Internet Access doesn't just protect you, it also offers you a feast of entertainment. When using entertainment platforms such as Netflix or Disney+, the content that you're able to access is restricted based on your geographical location. But using the Private Internet Access VPN literally opens up a whole world of entertainment, enabling you to watch things like movies and sporting events that are not available in your region. Private Internet Access is available for all platforms, including Windows and Mac, and a subscription covers an unlimited amount of devices at the same time. Signing up is risk-free as there's a 30-day money-back guarantee, and Joe Blogs viewers are being offered an exclusive 2-year deal with 4 months free at $2.03 per month, which you can access by clicking in the link below. Now, this chart shows the movement in the official rate of interest in Russia dating back to the start of 2022. And as you can see, the shape of this chart is very different to the charts that we've been talking about for countries in the West, such as the United States, the UK and Canada, where at the start of 2022 rates were at an all-time low. However, over the course of the last 12 to 15 months, we have seen a significant increase in rates. Immediately following the invasion of Ukraine, Russia decided to increase its interest rate to 20%. However, between April and July 2022, the rate was brought back down to 8%, which was actually lower than the official rate of interest had been before Russia's invasion of Ukraine. The rate was then reduced to 7.75% in October 22 and held at that level until July 2023, when it was increased to 8.5%, and then we had a subsequent increase in August to 12%. Now, if you follow the channel, I'm sure you'll be fully aware by now that the general logic on interest rates is that when you have periods of high inflation, you increase interest rates because increasing the cost of borrowing discourages both individuals and companies from taking on more debt. So therefore, it restricts the supply of capital. If people can't access cash, then they generally spend less. That reduces demand, and therefore prices should come back down. So looking at the shape of this chart, you would have expected the reduction in interest rates that was seen between April and July to correspond with declining inflation, because you would only reduce interest rates if you wanted to stimulate demand. And conversely, you'd expect the rapid increase in interest rates that's been seen over the course of the last couple of months to correspond with extremely high rates of inflation to try to bring demand back down. But if we look at what was actually happening with inflation, it doesn't match that story at all. This time last year, inflation in Russia was running at 14.3%, and 14.3% is a very high rate of inflation. That's higher than we've seen in most countries in the West. But despite that fact, Russia had reduced its interest rates significantly and actually reduced them further in October 2022 when inflation was running at 12.6%, and then held them flat for a long period of time. And despite the fact that interest rates were being held flat, inflation continued to come down, and that is quite puzzling from an economic perspective. But what's bizarre when you look at this chart is the huge reduction in inflation that was seen in March 2023. It reduced from 11% to 3.5% in 1 month, at a time when interest rates hadn't moved at all. Inflation then fell further to 2.3%, and over the course of the last 3 months has increased to 2.5%, 3.3% and 4.3%. And 4.3% means that Russia has a significantly lower rate of inflation than the United Kingdom, Germany, Australia, Italy, France, Mexico and South Africa, just to pick out a small number of countries out of the G20. So in relative terms, Russia is doing quite well in terms of managing its inflation, and certainly does not justify an increase in interest rates of 4.25% within a 2-month period. And in terms of assessing exactly what the impact of that increase in interest rates will be on the Russian economy, it's likely to reduce demand, because that's what happens when you increase interest rates. And a reduction in demand in Russia is the last thing that the Russian economy needs right now, because it's already on its knees. And if we see the Russian population starting to spend less, that means that the Russian economy is likely to contract further. And so Russia has basically shot itself in the foot by increasing interest rates so rapidly in order to try to save the value of the ruble. Russia is a large country with a wealth of natural assets, and the fossil fuels such as oil, natural gas and coal that Russia exports all around the world underpin the Russian economy. That's what Russia has been built upon. So at this point in the video, I wanted to discuss what the impact of the deterioration in the value of the ruble is on Russia's export business. Now, generally speaking, if you're an exporter, when the value of your currency falls in the international markets, it should make the goods that you're selling abroad cheaper. So in order to get a better understanding of that, let's talk through a practical example. If Russia was manufacturing the proverbial widget, and the cost of manufacturing that widget, including Russia's profit margin, was 60 rubles, then 12 months ago that widget would have been selling in the international markets for $1, because the exchange rate at that point was $1 for 60 Russian rubles. Now, as we've discussed, over the course of the last 12 months, the value of the ruble has fallen, and $1 is now equivalent to 96 rubles. So to keep things simple, if we assume that over the course of the last 12 months, Russia's production costs for that widget have increased by 10%, the equivalent sales price in the international market today would be 66 rubles compared with 60 rubles this time last year. And at the current exchange rate, that widget would be selling in the international markets for 68 cents, compared to $1 this time last year, as a direct result of the reduction in the value of the ruble. So if the international sales price had fallen from $1 to 68 cents, in theory that would make Russian widgets more attractive in the international markets because the price has gone down, and potentially Russia could sell more of those widgets and make more profit. So that's the general economic theory as to how a fall in the value of your currency can actually provide some benefits if you're exporting products and the price of those products is determined by the cost in your home country. But unfortunately, from Russia's point of view, it doesn't work like that for the majority of its exports. Russia's main export is oil, and the price of oil is set in the international markets and benchmarked predominantly in US dollars. So when we talk about a barrel of oil, we talk about $60 or $80 or $100 for that barrel. We don't talk about how much it's worth in terms of rubles. So the deterioration in the value of the ruble isn't providing Russia with any tangible benefit because the market price is set globally. Now, as we've discussed before, at the start of the Ukraine war, President Putin tried to establish the Russian ruble as a benchmark for international fossil fuels. He made an announcement that all unfriendly countries would have to pay for natural gas in Russian rubles, and he was really trying to displace the dollar as the go-to currency when you're benchmarking these prices. But unfortunately for Russia, that hasn't worked. And the deals that Russia is striking with China and India to sell large quantities of oil are being benchmarked either in US dollars or Indian rupee and Chinese yuan, and that isn't really helping the Russian ruble. So unfortunately, from Russia's point of view, the deterioration in the value of the ruble hasn't provided it with any tangible benefits in terms of the goods that it's exporting, because the international markets for those goods are priced in other currencies. Now, in terms of assessing the impact of the deterioration of the value of the ruble on Russia's imports, it's the exact opposite of what we've just talked about for exports. As we've discussed, Russia is a net exporter, but the majority of goods it's exporting are raw materials, things like oil, natural gas and coal. And the Russian economy is not self-sufficient. It has to import lots of goods from all around the world. And as the majority of the things that it's importing are not commodities, the price of those goods is determined by the individual companies that Russia is dealing with. This time last year, $1 was trading for 60 Russian rubles. So if Russia was importing something that was priced at $1 in the markets, its consumers and companies would have to pay 60 rubles for that dollar. Today, the Russian ruble is trading at 96 against the dollar. So that means that all Russian companies and consumers would now have to pay 96 rubles to buy exactly the same product. So that's a deterioration in value of around 40%. Which would mean that over the course of the last 12 months, companies and consumers would have had to see an increase of 40% in their income in order to maintain the standard of living that they had this time last year. So essentially what we've seen over the course of the last 12 months is that the cost of all imports to Russia has risen significantly as a direct result of the deterioration in the ruble. And you therefore would have expected to see inflation hitting the sort of levels that we've seen in countries like Turkey. It should be running at around 40% if you look at what's happened to the value of the ruble compared to its imports. However, as we've seen from the data today, the figures published by Russia don't show that. They actually show inflation being at one of the lowest levels out of all the countries in the G20. But the bottom line in terms of imports is that the deterioration in the value of the ruble has caused an increase in the cost of imports. Now, in terms of evaluating the attractiveness of the ruble, if we look at what's happened with interest rates, they've increased significantly over the course of the last couple of months and are now running at 12% in Russia. So that means that if you put your money in the bank in Russia, you should be earning around 12% interest, which seems pretty attractive at face value. But let's talk about an example of an individual in Russia who has savings of 100 rubles. If that individual put the 100 rubles in the bank 12 months ago and earned 12% interest, it would be worth roughly around 112 rubles today. Now, in terms of assessing the purchasing power of that 100 rubles, this time last year, $1 was trading for 60 Russian rubles. So that means that if you were going to spend that 100 rubles in the international markets, it would have been worth around $1.66. However, the exchange rate today is 96 rubles to $1. So the 100 rubles today would only be worth $1.04. And if we include the 12% interest that had been earned over the course of the last 12 months, those 100 rubles would only be worth $1.16 compared to $1.66 this time last year. So even though the rate of interest looks attractive at face value, the deterioration in the value of the ruble in the international markets means that your purchasing power as an individual has actually fallen over the course of the last 12 months. So the high rates of interest are not offsetting the fall in the value of the ruble. And what this means is that the ruble is becoming less attractive. If your rubles are worth less today than they were this time last year, and potentially could be worth even less this time next year, you may decide that you no longer want to hold your savings in rubles or even be paid in rubles. And this is exactly what happens in many economies when we see dollarization. And dollarization is a term which describes a situation where people in a country decide that they have more confidence in the US dollar rather than their home currency. So this is something that we're seeing in countries such as Argentina and Turkey, where there's been a huge deterioration in the value of their currencies, and people now would rather deal in US dollars. Now, clearly, President Putin would be absolutely furious if he saw people in Russia using the US dollar rather than the Russian ruble. So dollarization is less likely to occur in Russia than it does in other countries. So what that means is that the people in Russia don't really have as much choice, and therefore will have to stick with the ruble, and we'll see the purchasing power of the ruble continuing to deteriorate if the value in the exchange rate markets continues to go down. So this is one of the reasons why President Putin is trying to maintain the value of the ruble. But unfortunately, he's swimming against the tide at the moment because of what's happening in the Russian economy. So what's the summary and conclusion today? Well, I wanted to post this video really to give you an update as to what's happening with the Russian ruble and what the implications of the deterioration in the value are for the Russian economy. As we've seen in today's video, the emergency increase in interest rates of 350 basis points that was announced on the 15th of August did result in a short-term fix in terms of the value of the ruble. However, over the course of the last couple of weeks, we've seen the impact of that interest rate rise dissipate, and the value of the ruble has started to deteriorate once again. And that represents multiple problems for Russia. The generally accepted principle is that the value of your currency is intrinsically linked to the strength of your economy. When your currency is doing well, it generally means that there's demand for your products, and therefore your economy is also on the up. However, when your currency is doing badly, it generally reflects problems in your economy. And as we've discussed in many other videos, there are significant problems in the Russian economy right now as a direct result of the sanctions that have been applied against Russia. Now, usually when the value of a currency falls, there tend to be some knock-on benefits for exporters because the products become cheaper in the international markets, and so those companies will do well. However, the problem that Russia has is that it's not setting the price of its main exports. Those products are being priced in the international markets, and so the fall in the value of the ruble isn't benefiting Russia from the exports point of view, and is actually detrimental in terms of everything that it's importing, because all of those products are being priced in dollars and yen and rupees and euros, and so the price of all of those goods has increased for Russian companies and consumers. And that's going to represent further bad news for the Russian economy, because Russian companies will be making less profit if they're having to buy in goods which they're then either selling on or processing before they sell on. It means that their costs are going up and therefore their profits are likely to go down. And from the Russian consumer's point of view, the price of things that they're buying is going up, and so that's increasing their cost of living and reducing their standard of living, and is likely to result in a reduction in consumer spending in Russia, which will pull the economy down further. And in virtually every other country in the world, we would start to see an element of dollarization. But as we discussed earlier in the video, I think that's less likely to happen in Russia. But the overall summary of today's video is that the Russian ruble crisis is not over. The increase in interest rates has not fixed the problem. In fact, that increase in interest rates is likely to cause further problems in the Russian economy, which will have a knock-on impact to the value of the ruble. And basically what we're seeing in the currency markets is a manifestation of the underlying problems in the Russian economy. And it will be fascinating to see if the value of the ruble dips below 1 to 100 again, and if it does, what the response is this time from the Russian central bank, because surely they can't just keep rising interest rates to fix this problem over the short term, but rather they need to do something that's going to have a longer term fix. So I'll keep you posted on any further news and developments as and when they happen. Hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.